Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Our objective is to try to help you have a more successful retirement. We have created this entire show and all of these videos really focused on trying to help you. We do this through questions that we can answer for you, so you can send those in to the email address that you see on the screen. You can go ahead and send it into the chat if you'd like. You can send these questions anytime during the week, and we answer questions that came up with our strategy sessions with our clients also. So looking forward to being able to help you. We believe that education helps people have a better retirement. We have working towards 1,000 videos now on this channel, so if you'd like to subscribe, you hit the subscribe button and then hit the little bell next to it to get notified when we put something new out, which is pretty consistent. So and then, of course, if you want to just meet with us and ask us some specific questions about your situation, you can do that by booking an appointment, 30-minute video or phone call with Ethan and I. Just go to the book appointment button that's up in the corner of our webpage, which is listed here, on this channel too. So look forward to being able to help you. Super excited for today. We have some good questions that came in and some things that we're going to cover today that hopefully will help you as far as that goes. I, of course, always like to start off the show with just a little commentary about what I saw happening so far this week in the stock market, and I'll share with you kind of the chart here. So this is the S&P 500 year to date. And you can see here what's happened in the last couple of days, including today. Market fell out of this range. We were in this range for 8 trading days in a row. If you look at that closely, you can see we were kind of bumping up against the top. But really, everything was revolving around waiting for the number coming out for the inflation, the consumer price index. And it came out this morning, and you can see what happened. The market dropped right away this morning and is kind of heading downward. And the reason is because the inflation was higher than expected. We take a look at that number here. So this is the index for year over year for the last 12 months. So we were at 8.6% increase in prices on this May versus last May. And you can see what happened here is we actually hit a high in March at 8.5, and then we dropped down to 8.3 in April, and there was some hope that we'd continue to come down, and then the Federal Reserve might be able to do something different in September. So they've already announced, and it seems to be pretty much baked in, that we'd have a 0.5 point increase in June, 0.5 point increase in July. They don't have an August meeting, so September maybe would be more reasonable. But with these higher inflationary numbers, now people are talking about the possibility of a higher increase, maybe another 0.5 point in September. They do meet next week, so we'll find out more when they are interviewed and they talk about what their thoughts are. They've been pretty clear about broadcasting what they see as far as that goes. So one thing that's very fascinating, though, if you take out food and energy, what they call core inflation, and this is a particular basket that the Federal Reserve does look at pretty heavily, mainly because they feel like this is something they have more control over. Saudi Arabia and Russia, et cetera, might have more control over energy prices than the Federal Reserve does. So they look at these other pieces that are in there. That's actually been coming down. It did peak out in March. And so maybe that helps as far as what the Federal Reserve might be looking at here as that goes. The big thing we're probably going to be talking about a lot here is really gas prices. We're here, you can see this chart at nearly $5 a gallon, nationwide. I live here in Silicon Valley. We haven't seen $5 a gallon in a long time. Would love to see that. But nonetheless, the price is going up. You can see there was a big jump really in February when the invasion of Ukraine happened. And so this is something that's not going to probably get better for a while, just because we have Europe pulling off of Russian oil, Russian natural gas, and Russian coal. And so that's going to make them have to go out and find, these resources in a very tight market already. And so that creates all kinds of issues as far as that goes. But 4th of July is normally the peak for gas prices. I'd be a little bit surprised if that happened this year. I think it could actually keep going for a while. But, we are in a seasonal time frame where gas prices do go up also. So that's impacting pretty heavily, the inflation numbers that we're seeing as far as that goes. So that's what's going on in the inflation arena. It's a big deal. It's the thing that we're all talking about and looking at and trying to figure out how this might slow down in some format and what the Federal Reserve has to do in order to get this under control. Of course, the big concern is the Federal Reserve will have to tighten up the money supply and basically raise rates by such a high percentage that it could kick us into a recession. So, that's what we're all kind of walking this tightrope to see what happens. I'll show you a couple things that are kind of interesting. This is a 2-year chart of the S&P 500. So you can see we had this pretty phenomenal run up. And then obviously as of the beginning of this year, we've had this kind of jagged downward motion. This big green blob, that's over my head here, is what's called a volume profile. This is a really cool concept. What we're looking at here is every one of these bars shows how many shares were purchased at that price. So when the bar comes over farther, and there's a bigger bar, that means there's more purchases at that price. And so if we look, for example, right there is a lot of overhead resistance. And you can see that 8 days that we spent was right under that. And what happens is, let's say somebody buys a stock at $10, it drops to $8. When it gets back to 10, they might take their money back. Hey, I got my money back. So they call that resistance. And so we dropped down below and then tried to get back up. We could not get through that resistance and eventually broke down. But now we actually have support. And so again, this is an area where a lot of people bought shares. It did jump up, right? And so they say, okay, I bought it at 10. It went to 12. I was pretty excited. If it gets back to 10 again, I'm going to buy, right? So that's what's called support. And so we dropped right down to the support level that we have here, today, this morning. But one of the things to consider here is there's not a tremendous amount of support under that. One of the disadvantages of running straight up, like you see here, is that you didn't spend much time at any one price. And so oftentimes that means you can kind of cascade, once you get through that. So this is going to be very important to watch this support level right now to see what's happening. This is the S&P 500 as presented by the Spider ETF. And so, it's not the be-all to end-all to look at support and resistance, but it's a very active ETF with a lot of volume. So it's a great one to look at, in my opinion, but just to clarify what this is. So anyway, that's what's happening here in terms of support and resistance. And the other thing that we're really watching for is the possibility of recession. I talked about last week pretty succinctly, the 3 big indicators that I'm watching. The 3-month versus the 10-year Treasury yield spread, and the leading economic indicators from the Conference Board, and the ClearBridge economic indicators, all of which right now are showing no recession in the next 12 months, but that can change. And so what I'm showing you here is the rate on the 3-year Treasury bill. You can see it's going up quite nicely, really, very much so. This should help your bank accounts and your savings accounts and those types of things should start paying more. CDs, short-term CDs should start paying more. We're up to 1.33%, but if you look at that pattern, it's pretty straight up. And then if we compare that to the 10-year Treasury, you can see the 10-year Treasury is going up recently, but not quite as smoothly and as fast as the 3-month. And so what they call the spread is the difference between the 3-month and the 10-year. And what we really want to watch for is if all of a sudden the 3-month starts paying more than the 10-year. The bond market has been very accurate historically at predicting recessions. Essentially what they're saying is that they're not willing to pay as much on a 10-year because the future doesn't look bright, right? When the 10-year is a lot higher than the 3-month, we're expecting growth. And when we see that opposite happen, what they call an inversion, we're expecting contraction, which would be a recession. So pretty far away. We got 3.15 versus 133. Pretty big spread between them, but you can see the pattern. There's a little bit of consolidation recently, so we'll see how this plays out also. So, that's what's happening in total. I think it's something we just got to keep watching and see what's going to happen here. Watch this support level. It's a time to be a little bit cautious, as far as that goes. We're not probably looking at significantly lower inflation during the summer. That's usually a higher inflationary time period. So we might not see relief on that CPI number until the fall, And so we'll have to see how the market plays that out as far as that goes. So nonetheless, that's what's going on this week so far, and look forward to being able to talk to you again next week about it. All right, Eason, let's move to some questions. What do we have for questions?
So, if inflation keeps getting worse, what are some possible good investments for the outlook?
Yeah. So, if you look, the overall stock market is down during this inflationary time period. The overall bond market is down during this inflationary time period, both because there's expectations for higher interest rates, right? So when rates go up, it basically makes equities, there's a couple reasons that equities might fall in that environment. Number one, it makes it more expensive for businesses to operate, right? If they go borrow, they're going to have to spend more for that interest and what have you. So we've got the scenario also where because inflation's going up, they're having to pay employees more, which can also impact their earnings. And then we've got the gas prices going up, and I know Target said that was one of their big problems was transportation costs had gone up so much. And so all of these are difficult on the stock market as a whole. And generally speaking, in terms of just which investments might do the best, there are three that have done well that could continue to do well if we continue to have similar scenarios. So number one would be a Treasury inflation protection security. So that's what they call a TIP, right? So it's a Treasury that is designed to pay more as the rates go up. And so what it does is it kind of insulates, at least somewhat so, the price, because normally the price would fall in a bond as rates go up. So that's what we're trying to watch out for as far as that goes. And that doesn't have as much of a problem in a TIP. Specifically, short-term TIPs have what have been doing the best, and that's certainly what we have in our portfolio. A couple of other areas that have done well so far this year are, of course, energy. Energy's up tremendously so far this year. I'd be a little bit nervous about jumping into energy just because it is so high comparison. And Saudi Arabia has mentioned that they're willing to come in and replace some of this Russian oil if needed. And so they could bring down the price themselves. So it's a little bit of a weird thing. But energy generally does well in these type of inflationary environments. And then the other thing that's doing well so far is utilities. So utilities are, a safe haven when the market's falling. They pay a fairly high dividend on a relative basis, and so that's considered an inflationary hedge as far as that goes. Obviously, one thing, if you have the money, is property, right? I mean, so if you buy a property, you have a high inflation for a long enough period of time, rents are going up. One of the big drivers of current inflation is the increasing rent. And so for those people that have rental properties, this is a pretty good environment, at least for them. Not so great for the renters, but for the owners, this is not a bad place for an investment either. I'd be a little nervous about buying new property just because we have had the lowest number of new mortgage applications for new home purchases in 22 years this week. And so new home building permits dropped last month, not significantly, but dropped. And there's some writing on the wall here with these higher mortgage rates that we might be seeing some slowdown in the price of real estate. So if you run out to go buy a property so that you can rent it out and have some increase, that could be a little bit tough to do right now with these prices too. So that's one of the things with both energy and real estate. They've had such a big run. It's a little bit difficult. Utilities could continue to do well. TIPS could continue to do well here too. So those are a few things that, obviously we can look at as far as that goes. Honestly, cash isn't a terrible thing either. It used to be always, the money markets paid zero. They're going to pay more now, but zero is still better than the stock market's down, 17, 18% on the S&P 500. Zero looks good. So, there are just some key pieces there to take a look at. It's not that easy to figure out because you really have to have some determination of what might be happening with the market. The market does work in advance, 6 to 18 months in advance. And so if the market starts to see some softening in inflation, the market could take off, and you're over here in these things that are designed to do well in an inflationary environment. So I would still have a majority of my portfolio in the broad arena just because things can change really fast. as far as that goes. So keep that in mind.
So is there any kind of like investment that you would recommend to get exposure to kind of the like utilities and energy without really overexposing yourself?
Yeah, well, it's just a matter of percentage of your portfolio, so that's important. We have targeted pieces that we use, anywhere from 3% to 6%, depending on the aggressiveness of the portfolio, or even down to zero, depending on how conservative the portfolio is. But one of the pieces for energy, there's two big ones. They're very similar, but one is the Spider Energy, XLE is the ticker symbol. And the other one is the Vanguard Energy with VDE as the ticker symbol. Those are both pretty good. The Vanguard is more broad, has a bit more in it, is a bit more volatile. The XLE is just S&P 500 companies only, so it's a little bit more, conservative. But both of those are really good quality. Mostly they're driven by Exxon and Chevron for both of those. They're the big holdings. If you look at the utility side, again, Vanguard Utility VPU is a good one. Very similar, XLU is the Spider Utility. XLU is S&P 500 only. The VPU has a much broader portfolio. Both of those are fine, in my opinion, for this particular environment as far as that goes. And so that, it's a good question.
So polls are showing most Americans are very pessimistic about their personal finances. Is there any strategies to kind of, I guess, sleep better at night?
Yeah, right. I mean, this is one of those environments where it's just sort of, we get this hope. And we had this big run at the end of March. Okay, we might be up, and then it comes back down. And we had a 9% run just a few weeks ago, and then we got sideways. We're bouncing off the top. There's some hope there. And then the hope gets dashed, at least, for now, because the inflation number comes out higher. And so, how do you sleep better has a lot to do with just being able to, kind of understand, your overall scenario. But you're in good company. And let me share, some info here. This is the consumer sentiment survey. So if you're nervous about your investments and having trouble sleeping, there's a lot of people in the same spot.
Yeah.
So what this came out, and they tried to describe, this is going back to the 1950s. This week, just today, this was just released today, the consumer sentiment surveys, you tell them what they ask and kind of what they're looking at there.
So it's basically a questionnaire where they ask people, 40% on kind of like a present scenario where you feel you are now, and then what's going to happen in 6 months. And so the other 60% is about the future. And so people aren't very bright on what's going to happen in the next 6 months. They feel we're kind of going into a recession.
Yeah, and so this survey is at 50.2, right? That's the lowest it's ever been. And so, but if you look real closely, it's a little hard to see this, but if you look, the one that was almost as low is right there in 1980. And if you listen to the headlines, the inflation number that we keep beating, like today, was the highest inflation year over year since 1980. So it's the same environment where people feel like, okay, costs are going up and up, and every time I go to the gas station, I get nauseous, and all these things that are happening, and my paycheck maybe isn't keeping up, my portfolio certainly isn't keeping up, that kind of thing. And so sentiment is out there. It is basically negative, right? Now, one of the things I think very fascinating to me is people are answering that poll in a negative way and then going out and spend money like crazy, because consumer spending is skyrocketing. Is part of the problem, which is ironic, is that too many people are going out and spending money on all these different things, and that's creating this inflation, right, scenario. And not to stop you from spending money, but that's what's happening. So again, there is a diverse dichotomy here between what people are answering in this survey and what they're actually doing as far as that goes. So I think it's definitely an issue. It's something to think about. And the way that I always recommend, how you deal with this and how you get back to a point where you can sleep better, is you just need to make sure that your overall situation is as tight as it can be. So you have a portfolio that meets your risk tolerance. if you're really nervous about your portfolio right now and it's going down more than you think it should, that's not a good sign because this is only about an 18% drop. I mean, this is every 3 years we practically get a drop like this. So you might be in a portfolio that's too aggressive, and maybe you need to kind of reassess where you're at and get back to a more, conservative portfolio so that that's number one. You have to have a portfolio that fits. I mean, we use a company called Riskalyze, and Riskalyze sends out an email to our clients every 3 months, and they can go in there, they answer a couple questions, and then it shows them for their portfolio how much that portfolio would have dropped in 2008, how long it would have taken to come back. And I really talk to the clients about, you have to be able to accept that.
Yep.
If you can't accept that, first of all, you won't get the bigger returns when the markets go up. But secondly, you'll end up kind of not sleeping well and maybe even, cashing out at a really bad time. So having the right portfolio, I think, is super critical to sleeping better. So, you should be analyzing that right now. This is a good time to take a look at it to make sure that you've got what you want in that portfolio. And that by level of risk, it's really mainly stock versus bond. Yeah. And then what type of stock would be probably the next level, right? Because you can have, I've seen portfolios with 40% stock that are more aggressive than a 70% stock overall allocation, just because of what's in there. Just a low number of holdings or really high volatile pieces. So those are the two pieces. How much stock and what types of stock do you have, and how much do those traditionally move?
Yeah, and I also think having a plan, with the financial plan, we can check, the Monte Carlo simulation, and you can see. And sometimes we test for the Great Recession. So we test, what would happen to your plan if '08 happened again. And so that's a really good way. And so if your plan's still stable with the '08 crash, you can sleep a lot better knowing that even though we're going to downturn, I still have a good probability of being successful.
Yeah, this is how I would answer it. It's how I would feel better. At least I want to know this. If the number's not good, I wouldn't feel better, but at least I'd know, and I could then start to make some adjustments to my portfolio, to my lifestyle, whatever I have to do to make this work. But in this Monte Carlo simulation, and Ethan's right, we can run a basic Monte Carlo simulation where we just say, okay, push the button, computer runs your lifestyle basically 1,000 times. And so we have everything in there. We have your assets in there. We have all of your incomes that are coming in, and we have all the expenses that you want to, pull out of your, to support your lifestyle, taxes, all of it. And so when we run basic Monte Carlo simulation, it says, hey, here's the chance of success. But we can also then go in and do a stress test where we do two things. Number one, look at what would happen if we had another Great Recession, as Ethan said. And number two, what happens if inflation stays high for the rest of your life? And what's the probability of success there? So, if we go in and stress test and we, push the button and that client comes out at 96%, they can sleep better, right? And so I think that's part of it, is knowing we all can see I've said this a million times, we can all see our statements. We all know what's happening. We can see the market. Nowadays we can go in and check it, really by the minute and see what's happening. And but what's really hard to tell is what that really means. Long term for the rest of your life. What's that mean? And how do you figure that out? To me, it's having this plan, and we have this set up so it's basically live. All the assets are feeding in on at least a daily basis, and then we just look at it and we can push that button and just get that Monte Carlo simulation number and find out. So honestly, if that came out in the purple, which is 75% or less, I probably wouldn't sleep better, but I'd have some new plan to try to get that back up, right? But a lot of times people just see the value of their statements drop or their accounts drop online, and they're just worried about that. And they're still sitting, let's say, maybe at 96%. That should help you not worry as much when you're still at a really high probability of success, even under stress testing scenarios like inflation and the high drop of the stock market.
And the nice thing about a financial plan is, too, it's an early warning system. Even if you're dropped down to like 50%, you still have time to adjust.
Yeah.
It's not going to be like, I'm instantly running out of money.
Yeah.
And so with these kind of early warning systems, we can make adjustments to your plan. Maybe we cut back on spending. Maybe we kind of change how the portfolio is structured to just have a better chance of success.
Yeah, yeah. Having a long-term outlook, being able to know where you actually are, being able to know, what impact this downturn actually has on your overall success is what you should be thinking about instead of just looking at the account values and the fluctuation that's happening there as far as that goes. So it's good stuff. All right, what's another question?
So, what are some strategies that you use to make sure that your portfolio is kind of defensive in a sense when the market is kind of churning for the worst?
Yeah, that's a good point, right? Because here we are, coming back down. Looks like we might be retesting these lows that we set back on, the 20th of April. Oh, sorry, 20th of May. And it starts off with just the overall allocation, right? You have to understand what that means. How much stock do you have? How much bond do you have? What type of stock do you have? What type of bond do you have? And, we use this company Riskalyze, right? The outside company comes in and analyzes every portfolio and every holding in those portfolios. And it assigns a risk number to that portfolio, and then it shows 95% chance, a projection basis, for how much you might lose in the next 6 months and how much you might gain based on the mixture of what's in there. So you can look at that and say, okay, does that work for me? Especially focusing on how much you might lose in the next 6 months. And it even shows the dollar amounts, which I like. Because, you saw somebody, you could lose 11%. Okay. I'd rather see the dollar amounts because that's really, what we focus on the most. And so you get to see that. You get to internalize that. You get to look at it and think, okay, is that right? And so that's the first thing. If you get that exactly right, you won't be thinking about becoming more defensive because you'll already have the right portfolio and it's designed for you and your own needs to kind of get through that downturn and let you kind of sleep at night and what have you. All right, so that's the first thing. Have the right portfolio. Have a way of analyzing that portfolio. This Riskalyze company sends an email to our clients every 3 months showing them the risk that they're taking in their portfolios. And I think that's fantastic, actually. It's really been very, very useful. And so then the next level that I would be looking at there is just a sense of, okay, now what do I have in my portfolio individually? So if I'm going to get more defensive and still wanted to stay in the same stock allocation, for example, you start looking at things like utilities that have, historically dropped less, in down markets. Those types of things, that you can take a look at. And so what you're looking at, in my opinion, is the standard deviation of that piece of your portfolio. And so the higher the standard deviation on a 1, 3, 5 year basis, whatever you're looking at, the more risk you're taking with that piece of your portfolio. So I'm always looking at that. It's one of the huge screens that I use, and I'm looking at exchange-traded funds mostly. But when I'm adding something, I've got some pieces that are slightly higher standard deviation for my more aggressive portfolios, and then I try to ratchet down that standard deviation on the stock side, for example, on my more conservative portfolios as far as that goes. So that's the thought process. There is just trying to have the right mixture for what you're trying to do. I guess the third thing would be the possibility of having stop losses in your portfolio. Can't do that with a mutual fund. That's why we use exchange-traded funds, because you can put in a stop loss. And so you can have a stop loss that basically you just draw a line in the sand and say, hey, if it gets below this, I just want to get out. Could be 5%, 10%, 20%. I mean, there's a whole art and science to picking the right stop losses, but putting stop losses in the portfolio allows you to just get kind of knocked out of those positions. And this can be a problem if it turns around, right? And it just goes whoosh, comes right back up. You lose. And so you got to be careful there with this. And it's something that's really for more of an extreme situation. But you can set up a floor in your losses and just say, okay, even if I'm going to miss out on some of the up run, I don't want to get below this, right? I would say you probably have the wrong portfolio if that's what you're doing, but sometimes we have things that have big capital gains that are still risky, And so, I mean, I've got clients who have very large positions in single stock that, they used to work at, still working out okay, but they've got huge capital gains, and they would maybe cut some of it back, but it's, you're guaranteed to lose a chunk of it
Yep.
because of tax, right? So maybe a stop loss on that so you could hopefully stay in. But if things do fall apart, okay, I get out for that piece, right? Just something to protect yourself. When we do the Monte Carlo simulation, we can also, if they have a high concentrated position, we can show them what happens if they, like, say their position drops by 50% or something. We can show them what that means. And then that kind of gets through to their, to their thought process of, okay, I need to protect some of that, possibly, especially if it, for some people, it doesn't mean that much. It's kind of amazing. I've done some where I take it all the way down 50%. They're still in the 90 percentile range on success. That's okay. But if it really, really dominates and moves their dial back a lot, then we probably need to do something to protect on that, even if it means taking a capital gain.
Yep.
Right? Just because we don't want to go all the way back down. And so anyway, those are some of the strategies that I'd be looking at to kind of make your portfolio defensive as far as that goes. Try to be there in the first place, being the one that works for you. And I think that's where it starts, and the rest is just, refinements. All right?
So our next question is a collectibles one. Should I include hobbies that can be profitable in my retirement plan? So in this question, it says, I love collecting baseball cards, and from time to time, I sell these cards for a profit. And, what should I do with this in my plan, and how should I report to the IRS?
Well, the IRS question's the easiest one. You probably should report it in some form or fashion. I mean, my outlook on taxes is just I don't want to poke the bear personally. I'd be very conservative there, but everybody's different. I remember once I had a client tell me that when he submits his taxes, he calls it his bid. This is my bid. This is what I think I owe. And if he doesn't hear anything back, then he just assumes the IRS, has accepted his bid. So I don't have time for an audit, so I'm not going to do that. But nonetheless, from the IRS standpoint, you want to report these. Actually, it's kind of amazing. Collectibles have gone bananas.
Yeah.
I mean,
so I had a friend's dad. So my friends and me, when we were small, we collected Pokemon cards. And my friend found a box of these first edition Pokemon cards in the attic. And so he threw it up on eBay, and he sold them individual packs, and in the end he came out with $86,000.
That's pretty amazing.
Yeah. But the crazy part now is, eBay and PayPal, they're reporting directly to the IRS. So you have to be careful too that you make sure that you report your sales. Otherwise, they're going to come for their money.
Yeah, treat it like a business, really. I mean, in the sense of, hey, I made this profit on these sales, and I think you'll do fine as far as that goes. Yeah, it goes. It's everywhere, right? I mean, it's golf clubs, old golf clubs. It's cars, paintings, of course. Have always had that. Not everything makes money, so that's one of the difficulties of it. It's sort of like the stock market. Not every stock is great, so you kind of have to know what you're doing, but. And the marketplace is global now, which really does open up the doors for a lot more potential customers. Yeah, you had Pokemon cards before, right? I mean, trying to sell them, maybe in a swap meet or something, right? You get out on eBay, or some of these big, platforms. That's kind of changed that whole collectibles arena. My son was telling me about people doing shoes, sneakers. Yeah, I mean, that's like a huge aspect of what we had, the NFTs, right, which was a collectible digital token, essentially, a picture of some type that you got, the code to. Those, peaked maybe. But somebody made money on them somewhere in there. So, yeah, I mean, as part of strategy for your retirement plan, maybe, if you really wanted to work at it, right, you could be hunting around for buying Poke cards at a certain price and hopefully being able to sell them at a higher price. I mean, that's essentially what we do with the stock market. I mean, we're hunting, looking and saying, okay, what's going to buy at this, and Apple's going to turn into, an even bigger company and worth more than it is now. I don't have any problem with that, actually. I think, especially if it's something you enjoy doing, And there's a lot of avenues now to do that. So I think it'd be interesting.
Yeah, as long as you're not kind of selling the future. That's the one caveat I would say.
Yeah.
You know, if you're not, you know, if this is a small hobby, saying you're like putting $5,000, $10,000, which isn't going to make or break your retirement into
Right.
this hobby,
Yep.
then it's totally fine. It's where I become concerned is when you start to like take that, you know, $50,000, $100,000, and you report, and if you were to lose it all, what would happen to your plan? And so, there's a balance. You know, can this hobby be profitable? Yes. Is it going to make or break my plan if it goes badly? That's one question you have to ask yourself.
Yeah, I start small. If it works, plow the profits back into it and just keep growing it, and eventually you could take some profits out. But if it doesn't work, you don't lose a lot, right? I mean, that's a lot. That's what we do a lot of times with more aggressive investments. Start small and just see what happens. And if it continues to do well, we kind of just let it grow. So, you know, if you're going to collect cards, or I have a client collects gold coins, pretty expensive, you know, and so, you know, you have to have a net worth that's pretty high to say that you can start small there, because a lot of those are $5,000 to $20,000 per coin. I think it's an interesting hobby in the sense that gold has a inflationary hedge aspect to it, and it's minted, right?
Yep.
So that could do quite well, actually, but a much more expensive hobby. And of course, you get into cars, you get the same thing.
Yeah.
Cars have done pretty well over the years, but pretty high buy-in price. You know, unless you're going to do it yourself, like a fix-up thing. Even that is going to cost you something. But that's nothing wrong with that. Matter of fact, I did have a client that used to do Mustangs. So that's one of the hobbies he had, that he'd fix up a Mustang, find one that was in bad shape, fix it up, resell it, and keep the differential. And, you know, he just kept going. And so, yeah, there's lots of ways of doing that. I think it could be fun.
Yeah, and always remember that this is a hobby that brings enjoyment. And so when you kind of add the money aspect, if you stop to have enjoyment, maybe it's time to take a step back.
Yeah.
Because I had a friend that loved fantasy baseball, and he loves baseball, but then it became like a kind of a second job for him when he played fantasy baseball. He was making money off of it.
Yeah.
But then he stopped rooting for his team and was only looking for the players to do well. And so he lost that joy. And so for collectibles, it's a hobby first, then you should have that joy from it.
Yeah, that's a good story, because I got into fantasy football when it first came out, and I was pulling up all these spreadsheets and everything, and I kept winning. I won and won, and then I started playing, you know, in the bigger money leagues. I had, you know, one year where I had to report a bunch on my tax return and what have you. But my wife always used to laugh at me. She says, "You're still only making about $1 an hour," you know, and it just kind of took over. And then the things that I was doing in downloading all this data and putting it together myself is now available. Everybody has that. But back then they didn't. So I kind of had a little bit of an edge. But yeah, it got to be a bit much. You know, I was getting up too early to see what happened with my trades or whatever. Yeah, it's got to be something that's, you know, enjoyable first. And then, you know, life is short. So yeah, that makes sense. All right. Do we have time for one more, or is that
Yeah,
it?
we have a little quick one. Should I ever take a 15-year or a 30-year mortgage? You know, which is the better aspect? You know, what should I do?
Yeah, this comes up. We hear this quite often, you know, because the 15-year mortgage has a lower interest rate, right? And I don't know what it is today. I know the 30-year mortgage is a little over 5.25, something like that. Hit 5.5, I know, at early May. And so I would assume the 15-year is maybe 1% less than that, or something along those lines. And so that's one of the main reasons people want to do it. And a lot of times they also just want to get rid of the debt faster, right? So they're kind of forced into this payment plan, and they got to, I mean, for example, I'm 50, let's say, for example, and I want to make sure I pay off my mortgage by 65. A 15-year mortgage, you know, that's a lot better than a 30-year mortgage where I want to have it paid off until I'm 80. And so it kind of depends on what you're talking about. And I'd say the number one thing to look at is the size. So, you know, you're talking about $50,000 mortgage that you got left that you're refinancing, or $100,000 or something relatively small. 15, 30 is fine. 15 probably works better in that environment. You're talking about $1 million mortgage or $500,000. The thing I would caution people about with a 15-year mortgage is that the payment is much higher, right? In order to get that through in 15 years. If I go take a 30-year mortgage and just make that higher payment, I can still pay it off in 15 years. Does take some discipline from me, which not everybody has. But let's say you do, and you feel like you can do that. The one advantage is if everything falls apart and we end up with a big downturn or something like 2008 or Great Depression or whatever it is, the lower your payment is, the lower, so if you had to, and you could lower that back down to paying just the minimum instead of paying the extra to get it paid off in 15 years, that gives you some flexibility. So I'm generally in favor of a 30-year mortgage, even if you're trying to pay it off earlier, on big mortgages, which we have a lot of around here. And just because, if everything goes south and the market goes south and the economy goes south, inflation goes up, all these things happen, you still want to be able to keep your house. And if you've got this high payment because you did a 15-year, that's a risk I'd be careful with, just to save some money on the interest rate. Because you could still save most of that money by just paying it off faster anyway. Again, so depends, on the scenario, but we get asked that quite often.
Yeah, you're kind of splitting the difference when you kind of pay that higher payment into a 30-year versus, doing a 15-year.
Right.
And so, if you lose your job, you still have that flexibility. Maybe
Right.
your emergency fund is built for your,
Yep.
just built for that 6 months.
Right. Yep. Yeah, exactly. It does take your own personal discipline, and not everybody trusts themselves to do that, and they really want to pay it off in 15 years. Then hey, go for it. Just acknowledge the risk that you're taking especially if it's a big mortgage.
Yeah, you could set auto pay. That's one really easy way to be disciplined.
Yeah, that's right.
Every time that hits your checking account, it automatically gets paid out.
Yep, exactly. And then again, you could turn that off if everything went south, right? And so you could bail yourself out. And you want to make sure you got a home. That's for sure. You don't want the bank to come take your home. So that's where I'd be careful as far as that goes. So good. Well, that's a great show today. I appreciate everybody who has been watching. Love all the questions. There's some good questions today, actually, really kind of different, some pieces that we haven't covered in the past. And I look forward to being able to see you again next Friday. Again, live stream every Friday from 12:15 to 1 Pacific time. You can send in those questions anytime. If you get some ideas from the show during the middle of the week, send it to us, and we'll put them up here. And obviously, you can subscribe to the channel to see what we're going to be putting in there. Hit the bell button. And if you want to, you can set up an appointment with Eason and I. Just go to the book appointment button, 30 minutes, just to get to know each other a little bit and see what we might be able to do with your situation, phone, video, what have you. So look forward to talking to you again next week. Thank you very much.